This is TreppWire Week in Review for the week ending August 23rd, 2024. I'm Carly Seto with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm back with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. As we entered the sleepy dog days of summer, this week saw a continuation of cautiously optimistic market sentiment following a streak of positive economic data in August, including retail sales and jobless claims. At the end of last week, the preliminary August Consumer Sentiment Index reading came in above expectations. But on the other hand, July housing starts came in below both forecasts and June starts. Goldman Sachs released a reduction in its recession gauge and said that if September jobs numbers look reasonably good, they will cut those odds even further. Stephen and Lonnie, given we're still within a couple of weeks of a severe market panic, are we out of the economic woods now?
You know, it's funny how back and forth this narrative goes. Because if you look at equities this past week, it's been okay. Now, granted, we've had some curveballs in earnings. So specifically, today we had earnings from Macy's and Target telling two very different stories about the health of the U.S. consumer. So Macy's was down significantly pre-market. Target was up significantly pre-market. And what it comes down to is, well, it just depends on ultimately your business strategy, the consumer you're targeting, what kind of brands you have in-house. And at the end of the day, it's really hard to make sense of all of this conflicting sentiment. But I would say on the whole, we just step back from it and take it collectively, it tells us that things are not all that negative compared to what we had a couple of weeks ago. That being said, we had a very interesting payrolls revision today, and it was a big one. On the low side, consensus was expecting around 600,000 downward revision to payrolls over the last year. And the more pessimists in the audience were expecting as much as a downward revision of 1 million jobs. Well, we got a downward revision of 818,000, which worked out to around 68,000 less per month in terms of jobs. And so bottom line, the job market was not as strong as what the data had been indicating, which is what we've been talking about for weeks, Lonnie. There's probably a little bit more weakness around the fringe than what really some of the data was indicating.
Yeah, I mean, Stephen, listen, what's a revision of 800,000 amongst friends? You know, I mean, the reality is we talk about this almost every time some of these numbers come out. Is like the headline number is what captures everyone's attention. Nobody goes back and pays attention to the revisions. In this case, though, 800,000, that grabs your attention. I think it's interesting, too, on some of the earnings. You look at TJ Maxx, like beat expectations, raise their forward guidance. We've seen that translate in the CRE sales of those centers anchored by TJ Maxx or having them as a tenant, all positive stuff. I guess my answer to Carly's question is, what if there are certain segments of the market that are still in severe distress, sentiments down, spending's down, consumers are tapped out. And then there's like this other half of the market that like things are stable, consumers are doing okay, spending's down a little maybe, or maybe even up for some luxury stuff. I think both can be true. Like, I don't think we live in a binary market at this point where it's either yes or no, it's either good or bad. And I think that's why the narrative sometimes feels like it's conflicting week to week. It just depends on what topic you want to talk at or from what perspective do you want to do your analysis. But depending on where you sit, I think you could, to your point, find just as many good things about the market today as you could bad. It's just where do you want to focus and where do you want to apply the pressure?
Exactly. And if we look at what's missing in the payrolls numbers, in the labor data, any undocumented labor that's coming in and really helping to keep wages from growing faster than potentially they could absent that labor. I mean, that's a positive thing, but it's very difficult to pin down. And I think that's absolutely in play. So this is where the election will get really interesting. Even Donald Trump seems to have pivoted a little bit on his stance there. So there's a lot of interesting underpinnings to the data that's coming out. And I think you're absolutely right, Lonnie. We can have two truths in this economy. And we had this rolling recession narrative that was bubbling up last year. And I think that still is in play. I think that's what you're seeing across various industries, that, you know, it's kind of some rolling pain through the market. And certain sectors have been absolutely more resilient and maybe haven't experienced that pain. But it's very evident in the earnings that some retailers they've been hard hit. It's as simple as that.
Yeah, I mean, we put out a piece this week, you know, effectively looking at MSAs and the bulls and the bears. And I think you could find that across the market. If you talk to people in CRE that are bearish, they have 100 examples of why they think the way they think, and they can show you exactly what's happening at a property level and losses. And we're going to talk a little bit today on some loss severity stuff. All factual, all real. But for every one of those, there's just as many people that could talk through, like, here's the signs of resiliency in the market. We've seen bounce back in sales. We've started to see some rent growth. We've started to see multifamily stabilize. It's just really interesting. I think we just have to understand, like, what we see is through the lens of our own perception. It doesn't necessarily mean it's holistic. And the one thing I would comment on, just kind of get your perspective on, I kind of liken it to the NFL at this point. Like, the NFL can show you 76 different camera angles on every single play, but they haven't put a chip in the football that actually shows you where the guy gets tackled. We're using like these BLS numbers and all these things. Like, we have all this real-time data that's like available. You can call it through an API. You can connect it directly to your internal system, but we can't get these numbers correct. We can't agree on the calculation. We can't. At what point do we say, it's great having like a chain crew of bringing the first down markers, but like, let's modernize a little bit and get into something that we think fits the times?
There's been plenty of efforts out there, and the location data is, as big as some of the shortcomings are, that data is really, really interesting to work with. Unfortunately, I haven't had the opportunity to work with it in an academic context to speak to its capabilities or what it can or can't do. But you're absolutely right, Lonnie. I will interject and say they have put a chip in soccer balls, and it's absolutely amazing. It's so cool. So they were showing a goal, and basically they're trying to pinpoint the exact microsecond when somebody had clipped the ball, and you couldn't even tell if the ball changed direction, that there was any change in spin, but you see this spike on the screen in the accelerometer. It's amazing. So yeah, they should be doing that in football too.
Yeah, I mean, like, if you're watching a baseball game, they can tell you the revolutions per minute of a curveball. It's just crazy. All right, we've digressed enough. There were several other things this week, kind of macro. Housing starts dropped by 6.8% month over month in July to 1.24 million. It was reported that was the lowest level since the 2020 pandemic, much larger than the expected 1.5% decline and below the long-term average of 1.43 million. If you look at single family housing starts, they declined by a massive 14.1% on a month over month basis. Some good news, maybe some silver lining in this, is multifamily starts jumped by 14.6%, which is a little bit contrary to like what people might think is good, because we had so much new supply delivered in 23 and the first part of 24, but we need to see some more multifamily construction given the affordability challenges that we have. But if you look at year over year, housing starts plummeted by 16%. So it's going to be interesting to see. And I've heard a lot of people talking over the last couple of weeks of how we bifurcate office now. When you're talking about office, you have to segment AA or Class A stuff from everything else. In the housing business, at least on the sales side, new construction sales are giving you a completely different indicator of what's happening versus existing home sales, because the lenders are able to buy down interest rates and do a lot of things to stimulate that market. We mentioned a couple of weeks ago, you had the new realtor commission regulations that went into effect on August 17th. I think you're going to see some real shockwaves in the market and from a sales perspective related to that. So interesting nugget. One other thing here, Stephen, get your thoughts on. There was an article in the Wall Street Journal this week talking about Rockefeller Center and the reinvention of that center. And this is kind of close to home for us since our corporate office is there in Rock Center in New York. But effectively, they're saying this developer actively manages the property. They've gotten utility of the buildings up, I think, somewhere around 70% of pre-pandemic levels. And it seems like a really nice narrative for Rock Center and for Tishman Speyer and the folks that actually run that. And obviously, being tenants there, like top-notch, great facility. Do you think that's limited to this type of really high-end center mixed use, or do you think this is something that's maybe indicative of a broader trend we'll see?
No, I think we can generalize this to some degree. If you look at certain developments around the country that are targeting experiential retail, in other words, I might not personally care about some of the high-end retail, but I love eating. And so just window shopping and being able to eat out and then maybe have something for the kids thrown in there, it's absolutely great. We need diversity and experience for some of these centers. Now, I will say, in fairness to Rockefeller, it doesn't hurt when you're in so many different movies. People want to come there and take their picture and replicate a scene or just say that they've been there. So that definitely helps out a lot. And one of the main underpinnings to this story was about the type of clientele. So they focused, starting out in the story, on Christie's and talking about how the clientele that comes there now really appreciates having some of that higher end fine dining experience along with the higher end retail. It's an all-in-one experience. And so it really depends on the consumer segment you're targeting. And if you're offering the market what it demands. So fortunately, it's not just high end at Rock Center. And it was fun getting to see this redevelopment in person, walking through the Rockefeller Concourse and seeing exactly how they were reconfiguring this space. It took a lot of capital to do it. It took a lot of patience. And I think that's ultimately one of the key things is, yes, they did their due diligence very thoroughly to make sure that the strategy that they were going to implement was going to check the boxes for the market segments that they were going for. And then on top of that, they had the patience, and was it about 300 million was the estimate? I mean, that's no chump change right there.
That definitely moves the needle. But they've done a great job of just allocating, to your point, like even underground restaurants are very nice, well appointed. Then all the stuff on the surface and above is just really, really well done. And I'll tell you, if you eat at the Del Frisco's Grill there in Rockefeller Center, if you get the cheeseburger with a sweet tea, it's $32.66. Not a bad dinner when you're there on a business trip.
That's good to know.
Thank you for wrapping up the intro and economic update here, Stephen and Lonnie. As a big fantasy football fan, I have to say that I hope a chip into football would get me some extra points to hopefully win this year. But let's stick to commercial real estate. Bloomberg this week shared an article on how the property downturn is creating the best opportunity in decades, according to Sterling Bay's CEO. What do you guys think about this?
I love it, because we've been saying this in so many different settings that with crisis, it breeds opportunity. And you're seeing this firsthand play out across the market. And when we think about specifically that term, this is some of the best opportunity we've seen in decades. And I think back to what was some of the best opportunistic buying points in time over the last, let's say, 50 years. 1980s. I think it's going to be hard to eclipse the 1980s and early 90s RTC days, right? And when you could pick up, say, land. This is one specific deal I'm thinking of down in Houston, the Woodlands, that the Woodlands was bought out of the RTC crisis. Right. And anybody who is familiar with Houston and the Woodlands can appreciate that 30-year land play that was made out of that crisis. And so many deals like that were made possible. So I wouldn't say we're at that level of opportunity, but it's certainly looking better. If we kind of break this down across the timeline and return of capital, I think it's honestly looking better than the 2008 crisis, because if you were buying distressed real estate at that point in time, we had such wild valuation swings and so much uncertainty. It took a while to flush through that stress. And I don't think we have that same level of problems in the system, but there's certainly a lot of opportunity. And so I think the rebound we'll see in property valuations will look better, hopefully, than the '08 crisis.
I don't disagree with you. I think the people that bought property during the RTC, like they're all counting their money and just loving it because that was a once in a lifetime type of buying opportunity. You talked about the Woodlands and some other stuff. I mean, you go to any major city, there was probably opportunity like in Texas that I'm familiar with. I mean, master plan developments, really large scale commercial deals, all kinds of 25 cents, 6 cents, 12 cents on the dollar type of transactions at scale that have really transformed entire regions. I would also agree. I think this could potentially create better buying opportunities than what we saw during the GFC. But if I were to take a contrarian approach, Stephen, just to kind of play a little devil's advocate here, do you think that the buying opportunity right now is a little bit overstated in the sense that prices got run up so high over the last 5 years with zero interest rate environment, cap rates that were compressed down to trailing 12s at 2 3/4, 3 1/4 type of cap rate, that even if you get something today at maybe 50% discount to the last time it traded, that there's really not that intrinsic value that you would have expected if you transacted at something with that big of a discount, just because the prices, just by definition, were inflated because the interest rates and correspondingly the cap rates were so much below what we've seen from a historical norm.
Absolutely. And it's going to be very segmented in terms of where the winners are. So some of the longer term plays, at least what I expect will be longer term plays, would be, say, like San Francisco office that we've talked about. You know, the discounts ranging from, I would say on the low end, it would be and I say low in terms of less of a discount, 60% up to, 80, or even maybe the craziest I've seen was pushing almost 90%, but I think 80% would probably be a fair cap on the discount there. Those plays could honestly take a decade to fully play out. I fully expect, versus, say, some multifamily stressed transactions might look really, really good in 2 to 4 years easily. especially if you're buying them in certain Sunbelt metros where there was just too much leverage injected too quickly, and you've corrected, and you're going to capture, hopefully, a more positive upside swing if you get an undersupply of housing in some of these markets. And it's very market dependent because, like you said, the multifamily starts in certain areas are still pretty healthy. And so in those areas, you might not see as strong of a rebound as you would hope for. So if you can find the areas where you have higher barriers to entry, but still strong population growth, that mix is always a winning combination.
Yeah, and I think you're definitely going to see the winners and losers from that. If there's one takeaway from this latest run up in the multifamily side is like, there's just nothing proprietary about value add when you improve units. Like putting down new flooring and countertops and cabinets, everyone can do that. Like to your point, like it's not even just new construction barriers to entry, but it's the value add, the availability of capital for people to then nullify your ability to drive rents. But in those markets where they're supply constrained and there are high barriers to entry, there should be some real growth for people that can afford to step up to those types of opportunities. You know, we are going to be out in Vegas here in a couple of weeks working with our friend Chad Carpenter from Revan Capital and doing a live podcast at the Western State MBA. And, you know, they've started looking at distressed offices and providing capital and doing things. He's partnering up with Ethan Penner, and we've had him on the podcast in the past. So to your point, in terms of like generational buying opportunities, like Ethan and Chad have made a name for themselves of being the contrarian play that have almost always hit pay dirt with these really large scale type of opportunities. So I would agree with you that I think there's some real good buying opportunities. I think it's just having the discipline and discernment to know what that is. And I think, you know, when I spoke with Chad earlier this week in preparation for the live podcast, and it's remarkable the number of deals by volume and by balance that they have to look at to find something that makes sense. But the ones that they can find that make sense are going to have a really hefty payout because they think that the fundamentals that you talked about are going to drive that future value that maybe isn't realized today.
Just thinking back to how many debt packages I looked at and ended up killing in 2008, did Chad throw out a number about what the kill rate was or what the hit rate was?
I don't want to speak for him out of turn, but I want to say it was something like less than 20% was like what actually made it through the process. My recollection is you're talking about something that's like high single digits, low double digits that make it through the first pass of something that's viable.
Yeah, when I think about just the amount of debt that's coming due and how dramatic the pullback has been, specifically in the office sector and lending, I got to think there's some really, if we're not talking about equity, if we pivot to debt, there's some really attractive opportunities out there if you're looking to plug a demand gap in the market for office loans, just given how much banks and some insurance companies have pulled back away from that sector. It's created some, I think, really interesting debt opportunities if you have conviction in an office building longer run that other lenders have passed on. I mean, you can, I don't want to say virtually name your price, but it's a very healthy return from what I've been seeing on some of these packages.
So Stephen, this week we actually put out a research piece that looked at potentially identifying opportunities. This is a really great tie-in to what we just talked about in terms of buying opportunities. And basically what we did in the paper is looked at how to fundamentally value a property. So like the business of building, the market, the competitor's tendency, how to identify undervalued assets or motivated sellers. And we did this on a regional basis. We looked across the MSAs and we came up with what we thought were standardized performance rankings. And we lovingly called them the bulls and the bears. And so, you know, we looked at things like job growth, onshoring of jobs, new housing, temporary weakness, you know, which may create big opportunities to supply housing, new deliveries, and industrial supply, demand, absorption. Pretty detailed. We actually line out exactly how we determined the rankings. And then we went through and identified. So we won't spoil the results on the podcast, but if you'd like to get a copy of our MSA property performance rankings, shoot us an email at podcast@trepp.com, and we'll be happy to send you a copy of that report. And this is hopefully something that we'll start doing on a monthly basis. So we're giving some real-time perspective to the market participants around where we think MSAs are, you know, winning, losing, or potentially moving up the ranking spectrum.
We also saw a seismic shift in the CRE loan servicing universe, with Trimont taking over about $475 billion of loans from Wells Fargo. Stephen, what do you think about this?
Oh, wait, I'm sorry, Carly. Did you say 475 billion with a B? That's nuts. That's huge. It's a massive deal. So, Lonnie, does that take them from 10th to 1st now?
Yeah, they definitely took the if you're not first, you're last serious, and they moved up into that pole position. So they've made a pretty big splash here. I think this is one that sends some pretty big ripples across the servicer industry and solidifies Trimont now as the largest. So really big news as this broke yesterday, and be interesting to see kind of what changes this means for the Wells Fargo book, what this means for that industry at large, if they bring some different perspective to how those servicers operate in the space. This begs a bunch of questions from the Wells Fargo side, why they wanted to divest of this. From Trimont, it's pretty clear that they wanted to be, moved into that pole position. It's always good when you get some transaction activity like this. I think we'll find out some more details and get a little better understanding of what the strategic play is over the coming days and weeks.
This has been kind of a long-tailed trend we've seen in the banking industry. So coming out of the 2008 financial crisis, there was a lot of regulation aimed at, effectively what was going to happen was banks were going to reduce their servicing portfolios. So the regulation was aimed at trying to address some of the capital issues or capital needs that banks have with these servicing portfolios. So long story short, I'm going to target just one of them that was, I think, one of the biggest, earliest movers in the space. Bank of America used to be the largest residential mortgage servicer in the nation. And around, I think it was 2013, they started selling off large chunks of their residential servicing portfolio. I want to say it was close to $300 billion. So, I mean, we're talking equal in scale to this announcement. And effectively, the new capital regulations made it a lot less attractive for banks to continue servicing mortgages in-house. It was a lot less profitable for them to do so. So you had a lot of private servicing companies pop up in residential space. And it's really not surprising to see this continue to play out now in the commercial space. So Wells Fargo ceding or selling to Trimont, I think, is probably going to end up being a very wise move for them from a regulatory capital perspective and optimizing business operations. For Trimont, this is an amazing win. I have to think they are very, very happy about getting this sort of scale in one slug. What I also hope for them is that it's not too much of a pain for the onboarding process. Because again, going back to Bank of America, they took over this small little company called Countrywide. Maybe you've heard of them. And it was an absolute mess for them. The stories I heard about onboarding that Countrywide portfolio into the Bank of America platform was incredibly difficult. It was very costly. It took a long amount of time. So I can only imagine the kind of headaches that come along with transferring this amount of servicing rights. But I think in the long run, it tends to be a huge win if all of a sudden you have the scale and are the 1,000-pound gorilla in the room.
Yeah, I think to your point, for Trimont, like to get this type of scale in one transaction, kind of unprecedented. And I would suggest with this type of investment, they probably feel really strong about their investment thesis and what they're going to be able to do here. So definitely something we'll be keeping an eye on. And, we'll update our listeners as we get more color on this and how the industry responds, reacts, if there are changes, if things, become more smooth or seamless. And this will be something that we definitely talk to. It's, we do a lot of research around special servicing and all the stuff that comes into play when properties start to struggle, and it'll be great to see how Trimont. It's not like they were not in this business; they just now have solidified themselves as the top dog. So speaking of special servicers, Stephen, we did release our July special servicing report earlier in August. It went out about August 9th, but I think it's salient for us to talk about it at this point, given what we just discussed with Trimont. So the special servicing rate pushed higher in July and increased 7 basis points to reach 8.30%. The rate was at 6.95% at the beginning of 2024. And interestingly, or maybe not interestingly, it's increased every single month since. It's currently at a 3-year high and is more than 180 basis points higher than it was in July of 2023, when the rate sat at 6.62%. It clears the July 2022 rate of 4.8% by 350 basis points. The new transfer balance to special servicing in July was a little lighter than typical, is on the lighter side, totaling just shy of $1.9 billion. However, the breakup across property types was very imbalanced, with the office dominating the overall sum. So if you get this report, you'll notice that we do a nice kind of summation of context in this and the delinquency report every month, where we give you some perspective on where the current rate is compared to the all-time high. In the delinquency side of the equation, we show all-time high delinquency was 10.34% in July of 2012 For special servicing, it peaked out at 13.36%. That was back in May of 2012, so coming out of the GFC. As we mentioned, the current rate is 8.30%. The office rate, if you parse office out, so for special servicing, the office rate is at 11.25%. And that translated to just over an 8% delinquency rate. And for retail, sitting at just under 10.89%. So this just continues the narrative of some distress in the market starting to play itself out.
As much as it is kind of painful to say this out loud, one person's pain is another person's gain. And one of just the funny dynamics of this industry is if you go to the CREFC conferences and listen to the panels, when you have the special servicers on there, you will hear them, at least some of them say, like, we're doing pretty well financially, obviously, because if you look at the amount of volume that's come in and how they're compensated, they're busy, and busy means they're getting paid. But from the borrower side, that means that things are not obviously going so well. So if we just to tie it back into the Trimont servicing deal, that is one of the really complex nuances of how you try and break into this business is valuing servicing rights, whether it's just master servicing rights or special servicing rights. How you bid on those can be incredibly complex, because what you're basically trying to suss out is the duration you think you'll be servicing this loan. It's been interesting to see some of the new entrants come into the special servicing market, and some players are trying to get scale. One in particular, I don't want to call out names and pitch this in too positive or negative a light, but I did see one new name come into the space that's trying to take on a lot more single asset, single borrower, special servicing business. And that's the kind of movers and shakers in this sort of environment that, to me, gets really interesting when you have new entrants.
Stephen, giving us a little bit of intrigue on this week's podcast.
Got to keep the mystery. That's what keeps the fun.
Social media is a massive and growing way to communicate with your prospects. But are you really maximizing the tools available to you? Some of the most powerful tools in human history are at your disposal, and most of them are free. So your prospects need to know how good you are. Have you ever asked yourself, what's the return on investment of these platforms or of my time? Or maybe you need to consider the other ROI, the result of inaction. Missing on these opportunities will cost you massively. Imagine supercharging your business development with a renewed focus on digital tools and social media at an in-person event. At the CREI Summit 2024, you'll get the chance to do just that. Join us at the fabulous Fourth Hotel in the heart of Atlanta on September 11th through 13th. You'll get to rub shoulders with the best in the CRE industry, learn from top-tier experts in social media, and take your business to new heights. Don't miss out on the event of the year. Buy your ticket today at www.creisummit.com, and we'll see you there.
Let's transition over to our credit stories segment. The first being a Manhattan office loan entering special servicing. Lonnie, I know you're dying to talk about this one.
Yeah, I was gonna jump in if Stephen tried to take this one, because we're making this the episode of special servicing. So at this point, anything that's special servicing related, I'm all over. So this is a Class A office space. This is in the prized Midtown East office submarket. Shocker, facing a maturity balloon issue. Not shocker. Is this indicative of the weakness in the rarefied air? That's how we framed it this week. So let me give you a little bit of the details here. $242 million, 521 Fifth Avenue loan went to special servicing due to the maturity default we mentioned a moment ago. This was according to the August data. Loan was originally slated to mature in June. It now shows a delinquency status of non-performing matured balloon. Property is 39 stories, 495,000 plus square foot. Class A office building in the Grand Central submarket. It was built in 1929 and renovated in 2016. The building's 77% occupied, with Equinox as a top tenant, occupies just over 5% of the space, and has a lease that runs through 2035. Commentary indicates the property is currently 77% occupied and reported a year-end DSCR at NOI of 0.84 times. Also mentioned in the commentary is that the lender's in discussions with the borrower for potential maturity extension. The lender will dual track foreclosure proceedings while continuing discussions until a resolution is reached. Stephen, 77% occupancy, Class A space, not able to get a loan in this market. What are your thoughts?
You know, when I read through some of the comments here, and granted, just for some transparency here for our listeners, servicing commentary can vary incredibly widely, whether it's the master servicing watch list commentary or special servicing commentary. And when I read through the comments on this one and some of the deferred maintenance that's been noted here, Yeah, when I shake the magic 8 ball, outlook does not look great. But that being said, some of the most recent comments do indicate that the lender will dual track foreclosure proceedings, but that they are in discussions with the borrower for maturity extension. So I think this is right on the cusp where, as long as it has strong enough possibility or probability that things can turn around and the capital will get a positive return, we'll see the borrower step up in some capacity. If anything, some of these deficiencies or deferred maintenance issues could actually end up being a positive bargaining chip for the borrower in a very, very funny way, because the borrower would maybe be planning on addressing these anyway and could say, well, fine, I'll commit capital, set it aside to address these issues. It's almost a non-issue, but it does show good faith in the negotiation process. So hopefully this goes the more positive route where we see capital committed, maturity extension granted, and this can ride off into the sunset, possibly to return to TreppWire again.
My takeaway here is when your top tenant only occupies 5% of the space, I want to know what is my weighted average lease term on the remaining tenants, because you have a lot of exposure to rollover, I would assume, with a bunch of smaller tenants in a space that size. We also had another office that went into special servicing. This one's from Maryland. 19.2 million Century Plaza loan enters special servicing. Again, according to the August data, loan was transferred to special servicing last month due to balloon payment maturity default. Kind of a recurring theme here. Loan matured in July of 2024, but had no extension options. The loan was current for most of its life, all the way through June of 2024. The next month, the loan showed a status of performing matured balloon, but in August was transitioned over to a delinquent status of non-performing matured balloon. This property has 168,000 square feet. It's in a suburban location in Columbia, Maryland. It was originally constructed in 1971 and renovated in 2013. Top tenants at this office location are Dental Care Alliance and Johns Hopkins University. The Dental Care Alliance tenant occupies just under 8% of the square footage, has a lease that runs through the end of 2029, and Johns Hopkins, which occupies just under 7% of the space, has a lease that expires in 2028. I know we have some financial details on this one here as well, Stephen. Why don't you walk us through that?
Sure. So I was just looking through this one, and when I look at the lease roll that's coming up, and in particular, the commentary also indicates that the borrower anticipates additional leasing headwinds are on the horizon. And when I look at the lease roll that's coming up, it's going to be a difficult upriver paddle, I think, for them. And so when I'm looking through the contract rents here, it's tough to think that these could go lower, because it's already at, I think, a pretty reasonable contract rent for what they've executed these prior leases at, ranging from low to mid 20s on a per square foot basis. So the full year 2023 financials indicates that the DSCR was 1.38 times when occupancy was 87%. 24 financials showing DSCR was 1.36% when occupancy was 86%. So reading the tea leaves here, I think it's absolutely possible that you could see some lease terminations coming up on the horizon, or at least some very difficult lease renegotiations, either for shorter term, for less rent. It definitely feels like there's some downside potential on this one. But like you said on the last, if you look at the tenant concentration, they do have a decent level of diversification. The largest tenant only takes about 7.6% of the space. So that does help blunt some of the impact here. It's just they might be hurting a few cats. From what I'm seeing on the lease roll, they have quite a bit coming due in a short amount of time.
Yeah, this one, for those that are interested, this loan makes up a pretty significant part of a 2014 deal, which is part of CMBX 8.
And just one more stat to throw out on this loan. If I look at the tenant lease expiration information that we have, it shows that we have 15% of space expiring within 1 year and about 24% expiring within 1 to 2 years. So that is a good chunk of lease roll that's coming up in the next 2 years here.
On theme at special servicing, we also saw a San Diego regional mall loan sent to special servicing. More trouble with regional malls and another maturity balloon.
For all you regional malls out there that are doing well, I'm sorry for this one. Yes, we have another. This is a $60.7 million loan on the Chula Vista Center. This loan was sent to special servicing for imminent maturity default in July. And this is according to August data. The loan was scheduled to mature in July, and since then, it has shown a delinquent status of non-performing matured balloon. The property is an 863,000 square foot regional mall located in Chula Vista, California. The asset was built in 1962 and renovated in 2012. The last appraisal on the property was at securitization in 2014. It came in at $116 million. But as of March, this property was only 67% occupied. Burlington Coat Factory, the second largest tenant, has 17.13% of the space, with the lease expiring at the end of April of next year. And speaking of concentration risks, this is also another CMBX 8 loan, making up 25.6% of the remaining collateral of another 2014 deal.
So sticking with the mall sector, Stephen, we got another Texas mall, but this one is resolved with a loss. So we're one step beyond the special servicing here. $21.7 million Mall de Las Aguilas loan had recently resolved for a loss. This was according to the August data. Back in 2015, at securitization, the property was valued at $40 million, later slashed to $7.3 million in 2021. The asset's most recent appraisal was March of 2024, where some of the value was recovered and it was appraised at $10.4 million. Sale proceeds on this came in at $10.04 million, and expenses were listed at $530K, putting the loss severity at roughly 50%. Subject property, 447,000 square foot regional mall located in Eagle Pass, Texas, was originally built in 1983 and later renovated in 2014. The mall's top tenants were Walmart and JCPenney, which occupied 25.3 and 22.5% of the space respectively. Commentary indicated that a foreclosure sale was conducted in July of 21, and our friends at CRE Direct reported to us that the property sold.
There's a lot more I have to understand about this credit story. Just to toss out a few more tenants at this property, they also have a Beals, a Ross Dress for Less, and a Cinemark. So it's a very different tenant mix than what you would typically expect. And this just tells you, like, the fall from grace for some of these regional malls has been very, very difficult, very painful. And so, if I'm looking at the expiration dates correctly, I mean, this is a tough one. You have 36% of tenants expiring within 1 year. This is probably another mall where the recovery value is putting it close to land value. That feels about right. There's probably some upside, and you can cut rents, continue operating this at a fairly low occupancy rate, and come out looking pretty well. If you're the second, third, fourth, however many times this asset has traded hands, yeah, it might be looking pretty well at this point, because that tenant mix, as we've talked about, is an absolute winning combination.
So let's finish up here with the retail stuff, Stephen. We had a $10 million Hillcrest shopping center. This loan was also resolved for a loss, according to the August data. Back when this property was securitized, valued at $14.1 million, which was then halved to $7.2 million in October of 2018. The asset's most recent appraisal from February of 2024 had the subject property valued at $3.74 million. So $14.1 million in 18 down to $3.74 million on the most recent valuation. 233,000 square foot neighborhood retail center, built in 1960, renovated in 1993. This is in Lower Burrell, Pennsylvania. The property has two anchor tenants. Rose's Discount Department Store with 34% of the space has the lease expiring January of 2026, and the Community Grocery Market, 17% of the space on a lease expiring in January of 27. This property became REO in September of 23. The notes in the commentary indicate that the asset received an acceptable bid at the auction.
Prior to resolution, this loan was part of believe it or not, a 2007 deal that was still outstanding. The resolution resulted in $4.9 million in liquidation proceeds, and that comes after $3 million in liquidation expenses.
So let's end our credit stories section with just one more special servicing update.
So last up, we have a Soho mixed-use building entering special servicing. Now, this is an office and retail space in a fashionable area of Manhattan that was unable to obtain takeout financing and has been unable to retain office tenants over the last several years. Specifically, we're talking about the $200 million Prince Building loan that is now in the hands of the special servicer, and this is according to a recent report from our friends at CRE Direct. The loan transferred to special servicing due to imminent monetary default. The loan was originally slated to mature in October 2022, but then exercised a 12-month extension option. We covered the Prince Building loan in a December 2023 edition of TreppWire after it exercised another 12-month extension to push its maturity out to October 2024. The collateral behind this loan is a 12-story mixed-use building at 568 Broadway that was built in 1897 and renovated in 2009. The total square footage is just over 354,000 and is broken down into just over 69,000 square feet of retail space and around 285,000 square feet of office space. And this is at the northeast corner of Broadway and Prince Street. This property suffered a pretty substantial drop in cash flow over the years, and the Prince Building in Manhattan's Soho area is unlikely to refinance its $200 million mortgage when it matures in October. Most recent financials from the first half of 2024 indicates a debt service coverage ratio based on net cash flow of 1.05 times with occupancy at 50%. This is significantly down from the full year 2022 financials, which showed a DSCR of 2.19 times with occupancy at 93%. And this is a fairly large loan, so it is split across two 2012 deals, and both deals are part of CMBX 6. And for our longtime listeners, you'll know that CMBX 6 is one of the more famous CMBX vintages, very popular with one of the, what is called the modern Big Short in CMBS.
Yeah, so Stephen, you mentioned the short. I think it was announced in the last week or so that Carl Icahn, who had been pumping significant sums of money into the retail short, specifically around the mall properties, has basically stopped his position there. And so it'll be interesting to see if anyone else tries to make that trade or get back into that mix, or if him pulling out, saying that's no longer his objective, if that just goes away.
Yeah, I mean, this has had lots of chatter going on for years now at this point, and I've heard arguments on both sides of this trade. It's a very, very interesting backstory. We don't have time to get into it on the pod, but for any interested listeners out there, I do encourage you to Google search Carl Icahn and the mall Big Short game that was played. It's a very, very interesting backstory that maybe we'll dig into a little bit more at a future episode.
As we turn to shout outs, I first want to plug our August Market Pulse webinar that will take place on Thursday, August 29th at 2 p.m. Lonnie and our friend Thomas Taylor in research will be covering 2024 office maturities, monthly MSA performance, and regional and property type series sales trends. Please register for that event. Check out our website and social media platforms for more information. Another plug for Lonnie, who joined Conrad Madsen on the C-Suite show this week. They discussed all things commercial real estate trends and advice, so make sure you're following and give it a listen. And another plug for Lonnie, who joined Conrad Madsen on the C-Suite show this week. They discussed all things commercial real estate trends and advice, so make sure you're following and give it a listen. That's a C-Suite show on YouTube or other podcast platforms. This week, we've also heard from Courtney S., who said the TreppWire Podcast is the best way to digest commercial real estate national markets. And the data we provide always finds a way to connect back to anyone who's listening. On LinkedIn, Dave L. gave us a shout out in a post sharing that he listens to the TreppWire Podcast every Friday morning and recommends it to anyone in the commercial real estate sector. Michael A. commented that he always loves listening to our podcast when he's traveling in traffic from North Fork back to the city. And Randy S. included us on his list of some of his favorite podcast gems to learn from experts.
Hey, so Carly, I wanted to jump in with a couple of shout outs before we wrap up this week's episode. So Tom W. giving us a shout out on LinkedIn last week. Danny G. also gave us a shout out and shared the CMBS special servicing stuff that we put out. It's really great to see people interacting with our information, sharing it, giving us shout outs. We really appreciate people interacting with us like that. Blueprint Commercial also had a really nice post on LinkedIn that talked about their team listening to our podcast episode 269. Thank you for listening. Thank you for shouting us out. Thank you for sharing our podcast with people that maybe haven't heard of us. We really appreciate the interaction. We hope we can continue to add value for you every week as we record these episodes. So thanks for listening, and we love hearing from you. So shoot us a DM on LinkedIn or shoot us a DM on Twitter or send us an email. And if there's any other reports that we talked about today that you'd like a copy of, you can always email us at podcast@trepp.com and we'll send you a copy of the reports as well.
This was a fun episode, guys, so thank you again for letting me co-host. With that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.